Okay, I think we might be going live here in a second. And let me see if that's actually happening. And yeah, so, okay, this is crazy. This is so exciting. Are you excited, John?
I am excited.
Okay, so I'm trying something new today. I'm trying out some technology and I'm interviewing my husband. For those of you that don't know, my name is Sonia Bush and I'm a realtor in Mammoth for Mammoth Village Properties. And today, what I want to do is introduce my husband, who's a financial advisor. His name is John Bush, and I've been wanting to interview him for a while now, but he keeps putting me off because the markets are really crazy. So during the week, he's busy. But here he is today on a Saturday, ready to help me out. So, hi, babe.
Hi, good morning.
Yes. And for those of you that don't know, yes, we do live in the same house, but I'm trying out technology. So he's in his home office. You can see the closet doors in the back. I'm in my home office and the closet doors are the same. So we're just a couple rooms away. But John, hold on a second. I want to make sure that we're actually live because I've been having some technical difficulties. So like I said, I'm learning. So it looks like we are live. All right. So the reason I asked John on here today is because he's been getting asked and I've been getting asked. We get asked questions all the time. And we like to say that our crystal ball is broken, but we do have some educated opinions on things. So before we get right into some tips and strategies in this crazy financial market, I thought I would first let you introduce yourself and tell a little bit about what you do.
Yeah, hi, my name is John Bush. I'm married to Sonia Bush for almost 38 years now, I believe. Anyway, I'm a financial advisor. And what does that mean? Basically, what that means is I help people out with their financial goals. And the biggest goals that I work on for most people are retirement. There's a lot of college education planning in there and savings for homes and things like that, big ticket purchase items. But the biggest thing that I really do is I help people accumulate wealth and then help them distribute that wealth back to themselves and to their families in a most efficient manner.
Okay, well, that says it very succinctly. So you like to say, or I've heard you say, that where you make your money is when things are crazy because you have to spend a lot of time chatting to people. Tell me a little bit about that.
Yeah, it's very true. My job is can be very stressful during times like this, and very busy. And what I mean by that, stressful in the fact that I work more, not that I'm freaking out and thinking the world's coming to an end, because I don't believe it is. When things are going well, the economy is going well, like it was prior to this pandemic. My job was a lot less hands-on because you call your clients up, you check in with them, you have meetings, and counts are always up. And hey, it's good, John. See you later. Talk to you later. We're right on track. Well, when things take a turn like they have recently, then that's when I really get busy, get to work, and make sure my clients are okay, make sure check in with them, see how they're feeling, and check out where their financial situation is. Have they lost their job? Has it impacted their income, their household? And go into what I'm going to go into with you, Sonia. I put an outline, and for all of you, of maybe the top 5 things that might help you today.
Okay, that sounds good. You're really cute when you're talking financial stuff.
uh,
All right, so I know you do have your list of top 5 strategies. So why don't we just dig right in? Where do you want to start?
Yeah, how to help yourselves get through these times. The 5 things I want to talk to you all about today is, number 1, the importance of having a financial plan. And then number 2, having an investment strategy in place. And number 3, what I like to call the big mistake, and this is where I really bring value to my clients. And number 4, some wisdom from some of the great investors that we can pull from and take to heart. And then number 5, I'd like to close it out with some of my thoughts, some of my advice today. So number 1, just having a financial plan in place. We all need a plan. whether we jump on an airplane and we're going from California to New York, we're out here in California in the beautiful Eastern Sierras of California. Nobody wants to go to New York right now, but the pilot has a flight plan, and you have to adjust to that sometimes. And the biggest thing in a financial plan is, for most of my clients, is income. How are we going to generate income? How are we going to make their nest egg last? And then also having some tax reducing strategies, and having an estate plan and investment plan and a risk management strategy. I mean, that is a very basic outline of a financial plan.
Let me ask you something really quick. So when you see someone for the first time, because that sounds like a lot, like to go in and do all of that. To make it simple, a financial plan in its simplest terms looks like what?
In its simplest terms, it's, John Bush, I have this amount of dollars and I need this much a month to live on. How can you grow this and make it last for me? I don't want to outlive my money.
Okay, got it. All right.
So, that's the basics of a financial plan. And I don't want to get too deep into the weeds on that, because it can be very complex, but at its simplest form, it's just what I said, making our money last. Nobody wants to run out of money and then knock on their kids' doors and have to move into their kids' home. And then number two, having an investment strategy. There's many, many ways to make money in the markets, in a portfolio. I tend to come from the value camp of being a value investor. But for most of my retirees, and when I say this, there's 100 ways to skin the cat. So it doesn't mean my strategy is better than your strategy. Often I'll have clients come in, new clients, and they want to sit down and we want to interview each other and see if we're a fit. And they'll come to me and they'll show me their investments, and I'll say, you know what, these are good investments. I'm going to tell you straight up, these are good investments. However, it's not my strategy. It's not my way of approaching it. So if you do want to work with me, because I want to stay concentrated and focused in what I do, I can't have 50 people come in with 50 different investment strategies. So this is what I do, and I'm upfront with them saying, hey, this is a good plan. You may want to stick with it, or you may not. I don't know where you want to go from there. And it can be, like I said, I'm value. It could be growth. It could be dividends are important. Bonds are important for retirees. I actually use a multi-strategy with my retirees. It used to be real simple. You could take a retiree's portfolio, put it in 60% stocks, 40% bonds, and draw anywhere from about 4 to 6% off that retirement portfolio and feel very comfortable that we weren't going to run out of money. However, that 40% bond portion now, as we all know, some of you may be refinancing your homes right now, taking out mortgages. Interest rates are at historic lows and have been there for a while. So we have to look for other strategies to help that fixed income portion of that portfolio. We can't just put it in a 5% bond or a 5% CD and call it a day, because those don't exist. So, part of my strategy is I want growth. I want global leaders. I want big companies like the Amazons of the world, the Apples of the world. I know some technology there, some Johnson & Johnson, those type of things. But I also want some dividend paying stocks, because that's where, we have to take a little bit more risk to get that dividend, get that income portion of it coming in. So that's what we have to do today to get a higher income. Your risk tolerance. This is really, really, really important. And we sit down with a questionnaire, and quite frankly, I've been doing this for a long, long time, and I can peel back the onion and just ask general questions and know, watch somebody flinch if they say, hey, if your portfolio is down 10%, and they watch them flinch back in their chair. I can almost tell by their reaction that, this strategy may not be right for you. This more conservative strategy may be right for you. And people always say in up markets, you can show them a 10% downturn, you can show them a 20% downturn, and oh yeah, I'm good with that. Well, it's like, you know what, if you have, $1 million and you're down 10%, that's $100,000. Well, in percentage points, that's not a lot, but in dollars and cents, that is a lot. So it's really, really important to try to match up that strategy, risk tolerance with the client. I've actually had clients come in and I'm like, you know what, guys, you're just not an investor. You probably need to go to the bank, put your money in a CD, put it on your mattress. This isn't for you, because I can put the best plan together, the best investment strategy, but if you're not sleeping at night, it doesn't do anybody any good. You're up at night and you're going to call me, keep me up at night. I can't stress enough how important your risk tolerance is.
John, you've said sometimes that, money is really emotional. And I think it's something the first question you ask people is something about how they feel about money, or what do you ask?
A lot of times you just ask people what's important to them about money. That question right there will open up a lot of answers. And money is not sometimes an emotional thing. It is the emotional thing. Quite frankly, better than a financial degree is probably a psychology degree in this business, because you're really dealing with people and their money, and it's a very emotional thing. We all have piles of it, if you will, or compartments of it. I have a retirement compartment, I have a cash compartment, and to give you an example for me and Sonia, and I think this might be a little bit of a guy-gal thing. If I don't have a couple $100 in my pocket, I do not feel comfortable. If I ask Sonia to go to the ATM and grab us some money, she'll come back with a $20 bill. And she knows we've been married long enough. That's what makes me feel comfortable. And, sometimes we talk about emergency funds. Everybody's comfort level is different. Sonia has some money in the bank. That's our emergency fund. She has a number that makes her comfortable. And quite frankly, if she's comfortable, I'm comfortable. Happy wife, happy life, as we like to say. And one of the biggest things in the investment strategy for retirees that really helps my clients weather these type of markets is having a couple years of income in cash or cash-like investments. And what I mean by that is maybe we have some laddered CDs that come due every month to meet their monthly income goals. And that way they don't have to liquidate in down markets. And quite frankly, some of my clients that I know can take that money and put it into the market, and maybe not all of it, maybe a portion of it. I'll recommend, hey, this is a good time to put some money in the markets. But having that cash cushion really, really helps people stay invested.
Well, and then when you talk about a cash cushion, I know when we were younger, our cash cushion looked different than our cash cushion now. And I know you used to talk about the little things that people can do, because when you talk about having months and months in savings, that's not really, or accessible, that's not really realistic for a lot of people, maybe older people. But for younger people, what do you recommend?
For younger people, hopefully they're still working. I mean, that's your number one source of income. A lot of people's hours are being cut back. A lot of people are on unemployment, record numbers of unemployment right now. You have to make the decisions, the spending decisions of, what you're going to spend money on right now. And right now, for those people, the most important thing is keeping a roof over their head, keeping food in the refrigerator, and keeping the lights on. For those people, this may be a good learning lesson for a lot of us. Quite frankly, how many of us were really prepared for a pandemic in our lifetime? Sonia gives me a bad time because I go to Costco frequently, and I come home with a case or two of toilet paper or paper towels, and she's like, "What are you doing with all that? What do we need that for?" Well, guess what? We need it. And I'm not a freak out kind of guy, and I'm a very optimistic person. You have to be an optimist to be an investor. But it's getting prepared, and you're just going to have to cut back and make do with what you have. And hopefully this lesson for all of us, unfortunately, the American way is to spend and stay in debt. And, that really started after World War II with that generation, the greatest generation of all, the baby boom, or not the baby boomers, excuse me, the depression babies, not the great, they were savers. They went through the depression, they knew hard times, and then World War II and the boom after that came, and this, all of us, we spent beyond our means. So
well, and then the advice for young people is something I know I've heard you say, and I know we did at a young age too, is when you can, pay yourself first.
yeah, I mean, yeah, Sonia's getting to the point of the magic of compound interest. In the example that I always like to use, and Sonia is saying, hey, pay yourself first. That's for sure. When the example I like to use is if you put $2,000 away for a newborn baby and get a stock market return over that for 65 years, when that baby retires, that 2,000, without adding a dime, another cent to it, that $2,000 is turned into just over $1 million.
You're kidding me. So if let's say my niece has a baby today, or our niece has a baby today, and we put $2,000 in and don't put another penny in, based on historical data, that would be over $1 million when that baby's ready to retire.
That is correct, based on a historical 10% stock market return over time.
That's crazy.
It is crazy, and that's usually what gets people's attention. And when Sonia and I first got married, and I was getting interested in saving for us and my job and everything, I told Sonia, I said, hey, we need to save 10 to 15% of our pay. And she's like, we can't do that right now. We're a young, looking back now, we're a young couple. We're just making what we're making. We're not making a lot of money. We have a mortgage, we have bills. And, that's where I said, well, we're going to start with something. And we started with our matches on our 401ks, which were 3%. And then every year from there, we started to bump it up. The first couple of years, it was just 1%. Then later on, we eventually got up to that 10, 15% mark. And, that's how you do it, guys. If you have a rich uncle or aunt, God bless you. I don't have one of those. Do you, Sonia?
Nope. All right. So I got you off your thing. Where were we on number?
Yeah, we're going to go into number 3. It's what I call the big mistake. And this is where I add my most value to my clients. Simply put, it's keeping you from selling and buying at the wrong times. And, right now, people are understandably concerned. The markets have settled in a little bit. Things are a little bit better than they were 3-4 weeks ago. The market did do an historic drop for sure. And that's never fun when you get all that volatility going on and the news is blasting and it's the end of the world. But you have to remember, I understand my clients' concerns. And quite frankly, most of my clients are pretty good about this because most of them have been with me a long time. It's not their first bear market with me, but it is definitely their first pandemic with me, my first pandemic, and hopefully my last. But what you don't want to do is get caught up in emotional selling, because now you've sold out of the market. Now you have to make another decision. When do I get back in? And quite frankly, most people underperform their own investments. Let me repeat this. Most people underperform their own investments. There's a company called Dalbar, and they do studies of mutual funds every year, and the average investor underperforms what the mutual fund did. Now, why do they do that? Because they either panicked out of the market and sold, or they bought into euphoria where things were really good and bought when prices were really high. So this is where I add, my most value. I tell my clients it's always okay to, my clients have my cell phone number, they have my email. It's okay to call me, email me at any time. You would not be human if you were not concerned, for sure. I jokingly during these markets, either if I'm making the call or I answer the call, I answer the phone. Hi, this is John, your voice of reason. And I usually get 1 or 2 responses, and it's either I just wanted to hear your voice, John, or I get a really loud laugh at the end of the phone. It's just Oh, thank God it's you. I just wanted to hear your voice, and we have a conversation. We go back to our plan. Kind of jumping back to that real quick. The plan that I use has software in it where we can test for down markets and bear markets. And like, hey guys, if and I've got some people that are retiring this year, and they're kind of thinking, man, maybe I shouldn't retire this year. Maybe I should put it off another year. And if that's what makes them feel good, I'm perfectly okay with that. But we've run scenarios into the software where, hey, this is what a market looks like when it's down 20% or 30%. And you're still going to be okay. And I'm not going to tell clients they're going to be okay if they're not, unless they're going to be okay.
So the big mistake is really hopping in and out of the market at the wrong time.
Yeah, it really is. It's just hopping in and out of the market. And that's all circles back to having a plan and having an investment strategy. And on the flip side of that, people buy, people might remember the internet bubble, the late 90s. People were actually firing their advisors because they only got them a 20% return. This was in a time when, the internet was going crazy, mutual funds, some of these funds were getting 60, 70, 80, 100% returns. And, everybody was going to buy these internet stocks and cash in and buy their own island. And people were saying Warren Buffett, the world's greatest investor, he's not invested in any of this stuff. He's an old fuddy-duddy. He's lost touch. This is all the new technology. Well, guess who got the last laugh? Warren Buffett. So sometimes I have to pull in the reins and say, hey, do we really want to take this type of risk? And I do it too. I said I was a value investor. I invested in Facebook early on. And that's done real well, but Facebook is not my financial plan.
Right. Well, I think one of the things you showed me this chart one time, and it showed, an upward trajectory of income, but then it showed if people would have pulled out, like on those days where they freaked out, if they just would have pulled out a couple of days, they actually made more by just staying the course and not dropping out. Wasn't that right?
That is correct. I've actually, let me see, I've got that pretty close handy here, I think. Yeah. So from 1997 to the end of 2019, had you missed the top 29 trading days, the upward moves in the market, your basic return would have been flat, as opposed to having more of the stock market return, like 10%, just 29 days. I don't know when those 29 days are. Warren Buffett, the world's greatest investor, he'll be the first one to tell you that he doesn't do market forecasts because nobody can do it. And, and that's why I like value investing best, because it gives you a little bit of protection if you're wrong. When you buy, we all want a value. If you buy something when it's low, that's what some of the world's greatest investors do. So I'm leading into, some words of wisdom. Sir John Templeton, who created Franklin Funds, he said the 4 most dangerous words in investing were, it's different this time. In the history of the markets, there's always going to be down markets. It's different in the time that, yes, we had to deal with a pandemic. It was different in the time that we had to deal with 9/11. It was different in the time that we had to deal with the financial crisis of 2008 and 2009. It was different in the Vietnam War. It was different when President Kennedy was shot. So there's all these events. We call it a wall of worry in our business. So the point being is, yeah, it's different this time, but it's not different. Keep on investing and doing the right things like that. And then Peter Lynch, who was also a fund manager for a fund some of you may have heard of, the Fidelity Magellan Fund, a really great investor. He said there's been more money lost in anticipating corrections than lost in the corrections themselves. I had a client of mine and I only have 1 or 2 of these that said, you know what, John, I want out. I don't feel like it's going to be right. And at some point you have to, respect your client, say, okay, this is what's going to make you feel comfortable. This is what's going to make you sleep at night. But I'm willing to bet that this person will do worse than the person that stayed in. Um, and then Warren Buffett, the world's greatest investor, and I've seen this time and again, it's not your IQ that makes you the best investor, it's your rationale, quite frankly. I've got some clients that are business owners, and some of them are high school dropouts. And they are really, really good investors. And not to pick on anybody, but I've got some really highly educated folks, won't go into their careers, but quite frankly, they're lousy investors. And I don't like to generalize, but I've seen that happen more than once.
What do you attribute that to?
Sometimes we're our own worst enemies. We think we're smart, we're wired how we're wired. We think we're smarter than we are, and you see the people that are in panic situations that can walk calmly through it and others that don't. It's just investing is the best thing that I like about my job, other than visiting with my clients, is watching people and their investment behavior. And I'll give you an example of, I've got some farmers for clients, and they'll come in and they'll say, well, don't give me any of that risky stuff. And I say, you mean like taking a seed, planting it in the ground, hoping that it rains, hoping that some insect doesn't come along and destroy your crop, or the crop's going to be overflooded with what you have and the market price goes down? Well, that's different. Don't put me in any of that risky stuff. So, we all have our comfort levels. And, the more you educate yourself about the investment process, the better off you are in some respects. In other respects, I've got people that don't hardly look at their statements. And quite frankly, they make the best investors because they just let time work for themselves and do its thing. I'll kind of wind this down, and then you can answer or ask me any more questions, Sonia. My advice today is, review your plan. Now is the time to review your plan. We're all reviewing our lives right now, how we're going to go forward, living our lives. We'll probably have a little extra toilet paper at our house going forward, right, Sonia?
Yeah. Thank you.
We live in an area of 8,000 people at 8,000 feet in a resort town, and we have a Vons and a Rite Aid. So we have to, we get an average of 30 feet of snow a year. So we have to prepare for things that power is going to go out, and all that stuff. And so I'm not a doom and gloom kind of guy into the world, but I want to be a little prepared. So review your plan. If you don't have one, this is the perfect opportunity to sit down with your advisor, put one in place, and really review your risk tolerance in your investments. Risk tolerance, I can't state that enough. And sometimes you don't know it until you're in a market like this. If you just started investing 6 or 7 years ago, man, this is great. The wind's been at our backs. The markets are going up. I love this stuff. Now you've experienced this down market, and maybe you don't love it so much. I always tell my clients, I've got to get them from point A to point B, and I don't want to take them on Mr. Toad's Wild Ride. And, we see on TV, the S&P 500, my financial plan is not to beat the S&P 500. My financial plan is to meet my clients' goals. So people get hung up on that sometime. If you have cash to invest right now, if you're in the fortunate enough position to do that, don't just dump it all in today. I tell people to, maybe take a 25% of it, put it in today, see what the markets are going to do. We've had this big rebound, and people are feeling more comfortable. It's very, very feasible. I'm telling all my clients right now, keep your seatbelts fastened. There's probably going to be a lot more volatility in the market. We don't know what the unemployment situation is going to look like. We don't know what the restarting of the economy is going to look like. We're going to get back to going where we were before, folks. And I mean the long term, not tomorrow, not next quarter, not next year, maybe 2 years, 3 years, 4 years. I don't know that answer. But what we want to do is put some money in. It's very feasible. Like I said, the markets could go back down and retest the lows, or even go below the lows where we're at. So be prudent about that. Have a systematic approach. whether you put it in once a month, once a quarter. Everybody, it's human nature. We all want the best deal. We want to buy at the lows. I've had people that had bought some stuff that, oh, we missed the very bottom. We're never going to get the very bottom. If you do, it's just luck. Warren Buffett, who invested in the 73, 74 bear market, bought the Washington Post newspaper, and it went down 50% from where he bought it from there. He obviously bought more, but he'll tell you today that's one of the best investments he made. So just be prepared for that if you have some cash on hand. And the big thing is, ask yourself, are you an investor? There's two types of people in my world. There's savers and investors. And the difference is savers fear the future and investors have faith in the future. And those two things cannot coexist, faith and fear. And once again, back to what fascinates me about my job is I truly believed we are wired to either be an investor or a saver. Does our experience shape that somewhat? Absolutely. But I am really, really, after all my years of experience, I am convinced it's in our DNA to either take a certain amount of risk, I can go into, taking no risk is taking risk. Is your money going to grow to meet your needs in the future? Is inflation going to eat it away? All that good stuff. But, if you're a saver, that's okay. Be a saver. You've got to sleep at night. Not everybody's an investor. And it doesn't have to be an all or nothing. Ben Graham, who was the father of value investing, Warren Buffett's mentor, in his book of value investing, I've got it up here on the shelf somewhere. He said a retiree at a minimum, even a little old lady with a pension orphan fund should have 20% invested in stock. So just because you're a saver doesn't mean maybe you can't invest a little bit. So just keep that in mind.
Good advice.
Thank you. I'm glad you're taking that. News. Okay, this is a big one. The news. I say to my clients, to my family, to my friends, it's okay to be informed, but not obsessed. The days are long gone of Walter Cronkite reporting the facts in the news. I don't care if you're conservative, you're liberal. Each news station today has an agenda. It's entertainment. Some of my oldest clients are going, I don't even watch that stuff. It's just entertainment. It's opinion. Some of it's fact, but don't get so caught up in the news. Years ago, my mom was, every time I call her, she's retired, I could hear the news blaring in the background. Okay, Mom, you need to take a little news fast. So I told her, she's watching the news all day, and then she called me up during the day. Did you know, this is happening? Yeah, Mom, I know that's happening. I tell her in the morning, you get to watch a half hour. At lunch, you get to watch a half hour. And in the evening, you get to watch a half hour. And a few months later, she said, man, I feel so much better. I'm like, no kidding. I had to make a long drive when this was all getting started. And to be fair, I listened to conservative news channel on my XM radio and liberal news channel. And Sonia called to check to see where I was along my drive. And she's like, how you doing? I'm like, you know what? I feel like putting a gun to my head. I don't know how people listen to this 24/7. So watch it with the news, folks. We all need to be informed. I don't watch a lot of network news. I tune it on mainly for my clients because I know they're watching it. They'll pick up the phone. Hey, I saw this on CNN. Hey, I saw this on Fox. Yeah, I know you did. Because I get so much news off my terminal and, without too much opinion. So be real careful with the news. And then my last thing that I want to close here with is, during this time, find a way to give back. There's a ton of ways for us to give back. I mean, there are old folks sitting in nursing homes right now who can't see their families. Pick up the phone, call up, just say, hey, I'm John Bush. And, I talked to your director and I know you're sitting there and just wondered if you wanted to chat. I bet they'd be more than welcome to do that. The reason I'm asking you to do things is, when we're giving, we're doing things, we're not focusing on ourselves. I'm actually kind of being tricky here and say, hey, focus on this over here. well, I'm doing this with your portfolio over here because time is working and you're kind of forgetting about it. So, you know, in a nutshell, I'm here to help my clients from not making the big mistake, quite frankly. And I don't know if you have any other questions, Sonia. I know I threw a lot out there, but it doesn't need to be complicated, folks. Keep it simple and having a plan during these times, and, you know, make sure you're checking in with your advisor. A good advisor will be calling you. That's what Sonia says, hey, I get busy. I immediately pick up the phone and I start reaching out to my clients and saying, hey, I know this is going on. You know, here's what we're doing. Here's where we are with our plan. And do you have anything for me?
John, I'm just looking at the comments and somebody texted me a message. What if they don't have a financial advisor? How should someone go about picking a financial advisor if they want to start with a plan?
Yeah, just like with anything else in your life, talk to your friends, your family, specifically your wealthy friends if you have some. You don't want to ask your poor friends who their financial advisor is. But, you know, referrals, recommendations, you know, that's how I do my business. Anytime I'm looking for something, it's like, hey, Sonia, do you know anybody that does this? And are you happy with them? And start there. And remember, there's many competent advisors out there, and not everybody's necessarily a fit. My first meeting when I sit down with a potential new client it's called, Are We a Fit? And I simply say, you know what, we could be two of the best people in the world, and you may not like my strategy, you may not like the way I part my hair, but sometimes people just don't click, and it doesn't mean they're not both good people. So make sure you click with that person, because it is a relationship. It needs to be a long-term relationship. You know, hopefully you're going to be dealing with this person for many years to come, and your family members or, you know, kids, everybody are going to be dealing with them. So make sure you have a fit there with the personality, because, you know, who wants to go and sit in a financial meeting, even if it's the best guy or gal in the world that does the best job, and just don't click. Life's too short. Find somebody that works for you, and just ask for referrals from your friends and family.
That's really good advice, John. Well, I appreciate you taking your time. I know you work hard all week and don't want to talk business all over the weekend, but I really appreciate it. Thanks for letting me test the technology. Like I
Thanks
said,
for having me.
What?
I said, thanks for having me. And I've actually got a little more work to do here on the weekend. So.
Okay. All right. Well, thanks. And I'll see you on the hallway.
Okay. Bye.
Bye.